we have a unique viewpoint to observe trends at both the advisor level as well as from the perspective from the industry's largest asset managers. Many are aware of the trend of outflows from active mutual funds over the past few years, while ETFs have experienced consistent inflows. But these broader trends don't quite align with what we see here on the Envestnet platform. Over the past 2 years, we see advisors' continued appetite for active funds. But our main takeaway from these insights is that advisors prefer both active and passive investment strategies. Advisors like active, they like passive, and they're combining the two together within client portfolios. We are strong believers in diversification across asset classes, but also diversification across investment strategy approaches, blending both active and passive investments together. The data in this quarterly update here provides us a high-level glance at how active managers as a whole has fared against representative asset class benchmarks. Here at Envestnet PMC, we have longer-term methodical research that serves as our guide to our active versus passive investment decisions. We like to remind clients that active management is cyclical, and when or if active management starts to outperform, this usually isn't in a wave across all asset classes at once. As you can see on this chart, active managers in both US and non-US equities produce solid returns across all styles and market caps. Over the past year, these active manager cohorts have produced high double-digit returns for these asset classes as well. Small cap equities were a bright spot during the quarter, for the average active manager outperformed across value, core, and growth investment styles. Small caps have actually outpaced large caps since the most recent market lows in October of 23. One of the main reasons for this outperformance is that most small cap managers have higher market caps relative to indexes, which has benefited during the quarter as larger cap stocks outperform small caps. Also, most small cap managers have been underweight financials, specifically regional banks, since the banking crisis in early 23. This has also been additive to excess returns. The market concentration made it a challenging year in 23 for most active equity managers, as a majority of the returns were driven by a handful of stocks. From our conversations with our active managers, most expect to see a broadening out of market breadth in 2024, which can lead for more opportunity for active managers. After a huge rally in the fourth quarter of 2023, bond prices fell and yields mostly rose during the first quarter of 24. Fixed income asset classes with shorter maturities outperformed longer maturity fixed income. And active managers in fixed income as a whole did fairly well relative to their asset class benchmarks. High yield and bank loans are typically a bit more resilient when yields rise, and the average active manager here produced positive absolute returns and outpaced their asset class benchmarks. Bond yields were quite volatile in 2023, and with expected interest rate cuts in 24, most of our active managers we engage with expect continued chop until there's more clarity around the economic backdrop as well as the interest rate policy. We believe this provides an opportunity for active fixed income managers as they have the flexibility to shift their portfolios given the dynamic nature of fixed income markets. Envestnet PMC is an industry pioneer in blending the two opposing investment styles of active and passive management together. We have been implementing this investment approach within our own portfolios as well as through our advisor consulting services for nearly 20 years. Finding top-tier active managers requires skill and patience. All this in support of our belief of active passive investing. I want to thank you for listening to our Q1 update on active passive, and please be on the lookout for our update next quarter.